If you're looking for more information on conventional mortgage and conventional mortgage requirements for 2023, then you're in the right place. Hi, my name is Scott Hastings. You've probably seen some other videos on here, but I am a loan officer. I'm based in Davidson, North Carolina, and I help people get mortgages in North Carolina, South Carolina, and Florida right now. So anyway, conventional mortgages. What is a conventional mortgage? I try to just be pretty simple in my explanations on my videos, and I don't want to get in too much detail. So conventional mortgages are basically mortgages that aren't guaranteed by the government, like an FHA loan or a VA loan or a USDA loan. So conventional mortgages are completed by lenders, and then they are typically bought by, you may have heard of Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac were chartered by the Congress, U.S. Congress, in the, let's just say the 70s, to supply liquidity to the mortgage market. In other words, to make sure that there was somebody to buy the mortgages so banks would make them. And so Fannie Mae and Freddie Mac have their own underwriting guidelines, which are the things that you as the borrower have to meet in order to get a mortgage. So that may have been a little overly more information than you needed, but that's what a conventional mortgage is. And I may look over to my notes. So if you see my eyes go over there, full transparency, I just want to make sure I cover all the topics. So it's important to know the requirements for 2023 because mortgage requirements change all the time. Guidelines change all the time. So for instance, starting in 23, the maximum mortgage amount that you could get changed. So now it's $726,200, which, is a lot depending on what market you're in. And that is different in different parts of the country. Like in California, it's going to be much higher, for example. So in this video, I want to go over, the credit score requirements for a conventional mortgage, income and employment requirements, debt to income ratio requirements. In other words, how much money you have to make to cover your debts, and the down payment requirements, which are depending on, if you're a first-time home buyer or you're buying a second home or a vacation property or investment property. Property requirements, what sort of conditions the property have to be in, and then we'll wrap it up. So, first of all, credit score requirements. If you do a quick search on Google, you're going to see that the minimum credit score requirement for a conventional mortgage is 620. Well, technically that is true. As in most things in life, there's a but. If you have a credit score of 620, you are going to have a lot of money down, and you're going to have a very low debt-to-income ratio, and it's going to depend on why your credit is a 620. In general, for a rule of thumb, I would say unless you have a credit score of 660, then you probably don't want to look at a conventional mortgage. And if you have a credit score of 660 or even 640, you're going to want to have at least 20% down. The reason is that the mortgage rate is really less affected by the credit score. It is greatly affected by the credit score, but much less than the actual mortgage insurance. So if you put less than 20% down on a conventional mortgage, you have to pay mortgage insurance. And if you have a credit score that is, not, let's say at least a 680, probably a 700, the mortgage insurance could be astronomical. Could be over $400 a month, which just wouldn't make any sense. Then you would need to get a FHA mortgage or something. But I would say if you are a first-time home buyer and you're trying to do sort of a low down payment mortgage, you probably want to have a credit score of at least 700, probably over 720, and that's for the reason I mentioned, mainly the mortgage insurance. So it really just depends. ultimately, all mortgages are going to be run through an automated underwriting system. So Fannie Mae has an automated underwriting system, Freddie Mac has one, and what they do is they read your credit report, they read the information that you put into the application. Now, when you put in an application, it's really just a form. So, I, as a loan officer, can go in and, change things around and make them work, the way they're supposed to be. And so this is uploaded and run through a Fannie Mae system, underwriting system, or Freddie Mac underwriting system, and it's going to say, approve or not approve. And then it's also going to spit out, some typical conditions. So there's a lot of sort of rule of thumbs when it comes to underwriting. And just from doing mortgages for 20 years, you sort of have a feel for what might work and what might not work, and learn some tips and tricks. And that's a reason that you need to work with a loan officer that knows what they're doing and has a lot of experience. Same with a realtor. So, we can talk in another video about how to improve your credit score. So you might get a conventional mortgage, but that's really not the place to do that here. So the income and employment requirements for a conventional mortgage. Well, all mortgages are going to look at income differently. So if you're a regular, say, W-2 employee, in other words, you make a fixed annual salary, or you have a fixed hourly wage and work 40 hours a week, then that's going to be fairly straightforward. And you can, in general, count all that income. If you have variable income, in other words, you make a lot of commission, you make a bonus income, you have overtime income, then that's going to be different. You're going to have a history of making that kind of income, and it's generally going to be averaged over the last 2 years. So that's where you're really going to have to talk to a loan officer to figure out the exacts, but be very careful about that. In general, for all mortgages, some income you're going to have to show at least 3 years of continuance. In other words, you're going to have to show that you are going to be able to receive this for at least the next 3 years. And those are things when people have alimony that they're getting. We have to get the full divorce decree to show how long the alimony is going to last. It has to last at least 3 years. Child support. Again, that's when we have to get a full copy of the divorce decree to show what are the children's ages, how much are they receiving, how long will it last. The reason for the child support is when the child typically turns 18, then they're going to stop receiving the child support. So if a child is 16, probably not going to be able to use that. 15 depends on when their birth date is. That when it comes to commission income, you have to have been on commission income for at least 2 years. Then there's going to be a 2-year average. There's going to be different underwriting requirements for overtime income. You will have to have worked overtime for at least a year typically to be able to use that and average it. So those are things where you need to talk to a loan officer, make sure they understand the underwriting guidelines, and provide full documentation. A lot of times, if it's towards the beginning of the year, it's a good idea to send the very last paycheck stub you got for that the prior year. So all of that will be broken out and it'll be easier to understand. Debt to income ratio requirements. This is a big thing when it comes to choosing between a conventional mortgage and, say, an FHA mortgage. The reason is the debt to income ratio requirements are going to be lower on a conventional mortgage. What the debt to income ratio is speaking to is, well, very simply, what is your ratio of your monthly income before taxes are taken out in relation to your monthly debts. So let's just say, for example, you make $5,000 a month. Well, you are going to have to, if you have excellent credit, and I mean over a 740 credit score, then you probably are able to get up to the very max, let's just say 50%. We'll just say 49% of your before tax income could go towards all debt. That would be the minimum payment on your credit report. So if you look at a copy of your credit report and you have a $5,000 credit card balance, it doesn't really matter what the balance is. It matters what the monthly minimum payment is. So you'd have to look at your car loan, anything on the credit report, student loans. If there is an amount, monthly payment showing up on the credit report, then that's what we would be able to use. If not, then we might have to use either 1% or 0.5%, whether we're doing a Fannie Mae or Freddie Mac loan. And of course, the mortgage payment. Now, the reason this matters is a lot of times, I have a borrower right now, for example, where they really are going to have to go over a 50% debt to income ratio, and they have very good credit. So you may need to do an FHA mortgage just because of your debt to income ratio. So, that might be a very good reason to do it. Another reason to make sure about the debt to income ratio is, interest rates. When you go over a certain debt to income ratio, typically 45%, then the mortgage rate's going to get a little bit worse. But ultimately, like I said earlier, every loan has to be run through an automated underwriting system to figure out whether it works or not. And it can be very tricky looking at the income and how much you can use, depending on whether you have, the hourly income, the base salary that I talked about, commission income, all these different things. So it's not completely straightforward. Down payment requirements on a conventional mortgage. So a lot of people don't realize that if you're a first-time home buyer, it's actually, and you have good credit, it's actually possible to only put 3% down on a conventional mortgage. A lot of people think that they have to get an FHA mortgage, which is actually 3.5% down, but that's not true. A first-time home buyer can put down 3%. So you could get, over a $726,000 house and put down 3% as long as the mortgage loan amount didn't go over $726,200, which is a fantastic deal. So if you are not a first-time home buyer, you always have the option of only putting down 5%. And again, with a good credit score, the mortgage insurance could be very, cheap, really, to tell you the truth. It's actually a really good deal. If you are buying a second home, technically it's possible at 10% down, but there were some changes that Fannie Mae and Freddie Mac made last year to where it's basically not possible because they make the interest rates so high and so expensive and that you just almost couldn't do it. So I would say in 2023, if you're buying a second home or vacation property, plan on putting down at least 20%. And it would be even better to put 25% down because the mortgage rate would be a lot better. An investment property is always going to require 20% down. And again, it'd be better because of the interest rate to put 25% down in 2023. I have a feeling that that's going to change when mortgage rates go down, hopefully later this year or next year. But right now, it's almost not possible to put down less than 20% on a second home and never on an investment property. You have to put 20% down. Another thing, well, that goes into FHA mortgages, so we won't discuss that here. The property requirements. I get a lot of questions from home buyers, especially real estate agents, who are like, do you think that this property will pass an appraisal? And they say, well, it should because it's a conventional mortgage. Well, FHA mortgages, not to talk about FHA mortgages here, but they have a much higher level of, properties have to be in better condition. So a conventional mortgage, I would say as long as it doesn't have any safety hazards, then you're probably going to be okay. And when I say safety hazards, if you have a back deck, for example, it needs to be replaced, and it has to be replaced because it's falling apart. Well, that's going to have to be fixed or torn down before you close on the house. That's a safety problem. But the house can be terribly ugly. It can have orange and pink and purple paint in it. The paint can be peeling. It can really just be super ugly and not in great shape and be okay as long as it doesn't have exposed wiring and things like that. An FHA mortgage, you wouldn't be able to do that. You'd have to not have peeling paint. You'd have to not have cracked windows. So, and you have a higher bar to meet when it comes to an FHA loan. I could go on and on about each one of these different points because the underwriting manual for Fannie Mae and Freddie Mac loans is probably 1,000 pages long. And so everything has different caveats, and every scenario is a little bit different. But I hope that this sort of answered your general questions about conventional loan requirements for 2023. Another thing that I wanted to mention is that if you are a first-time home buyer and you fall under a certain income category, and it's going to depend on the county you live in, then there are some really great benefits as far as interest rates. So you might have a lower credit score and still be able to get a good interest rate just because of some recent changes in the Fannie Mae underwriting guidelines. So reach out to me with any questions. I hope you like this. If you got any benefit out of it, it would help me out a lot if you would hit the like and subscribe button. And if you want any more information, you can go to my website, mortgagesbyscott.com, or put the questions in the comments below, and I will make sure and answer them. All right, thanks for watching.